All right, and we should be live. Welcome to Thoughtful Money. I'm Thoughtful Money founder and host Adam Taggart, welcoming you back for one of our bi-weekly macro sessions with the macro maven herself, Stephanie Pomboy. Hi, Steph. How are you?
I'm great. How are you?
Good. How is life out in the West this summer?
I mean, it doesn't suck. I will put it that way. And we're getting another beautiful sunny day out here. I hope the same for you.
Yeah, it's actually been one of the cooler summers on record here in Northern California. Nobody's going to cry me a river about that, nor should they. So it's still quite nice. I will say, Steph, it was fun to be back in your stomping grounds in Florida. Though very sad that we couldn't overlap while I was there with Ashley.
Yeah.
But we did have a good time. But yeah, man, it is hot and humid in
Yeah.
Florida in July.
It is disgusting. I mean, it's for people who like to be active and outdoors like us. I feel like it's just not a place to be in the summer at all. All you want to do is sit inside in the air conditioning.
Well, that or go jump in the ocean, which we did do, and that was
Oh,
fun.
good.
Yeah. All right. Well, look, Steph. So the past couple of times you've been on, we've had so much to talk about that we didn't have a lot of room for audience Q&A. So we're going to try to leave a lot of room for audience Q&A this time. So folks, if you're watching, if you've got questions for Stephanie, ask them in the live chat there. Steph, I also saw that you post on your X account a request for questions. I'm sure you got a ton. I'll try to pull from those as well. I'll kind of pick and pull here as we go.
Okay, great.
But I do have a couple of quick questions for you, and I had to come up with a title for this last night. So the title was MeltUp or BlowOff top. So we've seen the markets. We've been talking for months about how valuations, slingshot
Yes.
back to the valuation extremes they were at the beginning of the year. So it's sort of like the March, April 20% drop never happened.
Yeah.
Some people are saying, look, this is a market that's just a bubble in search of a pin at this point. And others are saying, no, man, it's a brand new world and the golden age of America is coming and, stocks are just getting warmed up. I think I know your point of view on this, but I mean, what do you have to say to people who are watching this and scratching their heads and just saying, man, this market looks bulletproof?
Well, if you can see this, spot here, I'm scratching my head a lot too. Oh man. I feel like, the markets obviously got extremely concerned about the tariff threat back in April and have recovered all of that and then some since. On the idea, of course, that resolving the tariff issue somehow was going to set us on the glide path to ever higher valuations.
Mm-hmm.
And so far, that has been the case. But as you and I have talked about forever, there's going to be a transition phase. The president himself acknowledged that. The Secretary of Treasury has acknowledged that. And so I think while everyone's understandably enthusiastic about these pro-growth business policies that are being put in place, tax cuts, depreciation, massive deregulation, all of which are tremendously supportive of growth, there is going to be a transition phase. And I think the real obstacle, and I hate to be such a broken record, but I keep coming back to it, is what happens on the interest rate front. And as long as long rates refuse to really come lower, it's going to make that transition really fairly bumpy because we've got just an enormous amount of debt, not just in the government balance sheet, but in the private sector, consumers and corporations, which we've talked about at length here. And all of these entities have been waiting and kind of tapping their fingers on the table, waiting for rates to be lower so they can refinance and get some relief on their incredibly onerous interest expense, which for consumers, households, and the corporate sector has more than doubled since the Fed raised rates back in March of 2022. So if that relief doesn't come quickly, obviously it's going to continue to weigh on economic activity. And we've also talked at length about specific things like the resumption of student loan payments and how that will impact. And I just did like a quick side-by-side comparison of what's the potential hit to consumer spending from the resumption of student loan payments versus what's the boost to consumer spending from the elimination of tax on tips up to 25,000. And the estimates are that the potential lost consumer spending from student loan payments will be about 50 to 60 billion annually, while the tax on tip thing is likely to free up about 2 to 3 billion annually. So there's no comparison as to which is more powerful, the drag of debt service versus the no tax on tip. So, and as relates to just obviously the extension of the tax cuts, that's great, that we avoided a huge tax increase, but it doesn't change anything for the average household. It's just extending the status quo. So
Right.
that's sort of a very broad and generalized answer to your question. But yes, I think that these markets are levitating largely on hope and also on things that they've thoroughly discounted, especially and including Fed rate cuts and the prospect that rates will be lower, in the foreseeable future.
Okay. Yeah, great answer, and it comes down to the topic you and I talk about pretty much every one of these sessions, right?
Yes.
It's sort of higher for long. How long can higher for longer continue without starting to drag down the economy and then therefore asset prices materially? And for whatever reason, the markets are not worried about that at this point in time. But it does seem like unless something does change to either bring those rates down materially and or like really turbocharge economic growth to the point where real wages are really growing strongly, then it's just math. So anyways,
Yeah.
but then again, the market doesn't have to care about our math.
Right.
At least not on
Math
the
has
daily.
not been an issue for the markets for a very long time. So
Yeah. And Steph, just FYI, I hesitate to mention this because I know you're not a techie. Folks, we started a minute or two late because we were trying to troubleshoot a microphone issue. Folks are saying your mic is a little hot, Steph. Folks, I'm presuming you can still hear us okay, but let us know if it's getting in the way. And I don't know if you can fiddle with the gain on the microphone that you have, Steph, or even if we should do that during a live recording.
that the volume is too high.
Yeah, there's usually something on a mic called gain, which it's sort of like volume, but if
Oh,
it
here we
gets
go.
too high.
How about, is this better?
I mean, the thing is, I haven't really been hearing much of an echo, but I know you
Okay.
were, and some of the other people here were. How does it sound to you?
I mean, it all sounds the same to me, but I just found a button that says mic volume and I pushed it lower. So hopefully that'll help. But
Okay, good. Well, somebody here just said audio is fine for both of you. Somebody here just said it's an echo. So we'll see what happens here. But let's just soldier on. We got another sound. Well, it's funny. Half here sound, half here echo. But we'll just soldier on. Okay, so sort of sounds like your answer is you're more on the markets are a bubble in search of a pin, and maybe that's too much of an exaggeration, but it's you're waiting for the math to kick in here.
I would say though, Adam,
Yeah.
even if markets continue to levitate or just churn sideways as the news is delivered, they've bought in anticipation of the lower rates. And even if they don't sell on the news of the actual rate cuts and just kind of continue to move sideways to higher, in real terms, and I keep coming back to this, the market is down. So yet again, we've got gold up 30% year to date. The S&P is up 6%. And even gold is even beating NVIDIA. NVIDIA is up 26% year to date. And it's not even close to the gold miners, which are up 60%. So you really need to be aware of what's happening with the dollar, which is down 10% so far this year, and the impact that's having on the real value of your investment portfolio.
That is a great point, Steph. Well, maybe let's trundle into gold real quick, and then I'll start pulling some questions from here. Actually, there's one more topic I wanted to get you on too, which is the Fed, and we'll get to that in just a second here. So, gold has had a great run. It has, sort of been trading in a range of late, but it's a very nice range. It's sort of between 34.50 and 3,300 or so, and we're getting back into the higher end of that. But as you said, we're really starting to see the miners build some good momentum here, and we're certainly seeing silver build some good momentum. I haven't looked at it in the past 30 minutes, but 30 minutes ago it was flirting. The silver futures were flirting with $40 an ounce. So those are numbers that would have thrilled all of us just a couple of months ago, and also technically, if it punches above 40, there's a lot of folks saying there's really not much to keep it from getting to 50, technically speaking, pretty quickly. So this is got to feel like some validation for you, because you've been out there for a long time, saying, hey, I believe in the precious metals for these reasons, and for probably more years than you and I would have wanted.
Right.
They were a coiled spring, but they hadn't really moved yet. But now they have moved, and to your point, I mean, they're moving faster than most meme and story stocks right now.
Yeah, absolutely. And it's what I love about it is that it's still getting no love. No one, if you watch the financial media outlets, is out there talking about, hey, look at gold, while it's 24/7 crypto and Nvidia and AI, and there's no attention being paid to gold. It's still massively under-owned. People like to talk about, and ever since I've been in the business, which is longer than I care to confess, we've had this promise of the money mountain, which was all of the money sitting in money market funds that was on the sidelines and would come rushing in to the markets. And that was always, and has forever been, one of the pillars of the bullish case at any moment in time. You could say it a month ago, 5 years ago, that's critical. And no one bothers to look at the total money market assets relative to underlying positions, total market cap, much less household exposure to equities versus their exposure to money market funds. But I digress. Point is that I think the argument people should be making is what a 1% increase in broad allocations to precious metals away from equities would do to that space. I mean, the numbers are almost unfathomable because the market cap is just so tiny. I mean, I remember, I haven't updated it. The last time I looked at it, the total market cap of all the gold miners was less than Home Depot. And forget about where they are relative to Nvidia. If people took 1/10 of their exposure to Nvidia and put it into the miners, we see them double or triple in no time.
Yeah, I was, when I was in Florida at this conference, I'm doing this from memory, but somebody put a slide up. I think it was Adrian Day, and it was the market cap of the top 5 companies in the S&P 500, and it was a lot, maybe 15 trillion or something like that. I mean, it was a lot. And then they compared it to the market cap of the top 5 largest precious metals mining companies, which collectively together were, I think, like half a trillion, maybe ish, maybe like 450 billion or something like that. And so then he just said, okay, well, let's just put the entire mining sector there. And it rose to like 650 billion or something, right? So, I mean, it's so tiny compared to the market cap that's just in the top 5 stocks, right? So to your point, Steph, if even just a tiny sliver of what's in the general S&P 500 were to wake up and say, you know what, I really like the momentum and the potential that the mining stocks have, and I want to trundle over there, it would just swamp multiples of market valuation likely, and that's just equities. How about the people that are in bonds and basically saying, I'm not super optimistic about where bonds are headed from here. Maybe I want to go into another safe trade, gold related assets. And what if 1% of the bond market were to trundle over into the precious metal space?
Yeah, it's just crazy. I mean, I try not to think about it too much for the same reason that I never thought about the money market fund assets flowing into the stock market. You get excited about it, and these things generally don't happen. But even if it's a modest and slow increase in exposure to the metals. But at the same time, obviously, we've got global central banks that are rapidly accelerating their allocation to precious metals. So that continues to be a huge support.
Yeah, and it's funny. I'm just going to share this because I'm guessing some other people are experiencing it too. I have most of my money managed by a professional financial advisor, just the way that I recommend that most people watching this channel should do. But I do have, a portfolio that I myself manage for myself, and that's where a lot of my more speculative gold mining companies are. And for years, I've been so accustomed to just looking at that and just seeing a sea of red.
Yeah.
And just seeing, these gut-wrenching double-digit losses in a lot of these individual miners that I'd bought. And by the way, that's why I remind folks that buying individual mining shares, it's hyper speculative. But I was looking at it the other day and I was like, wow, like it's almost all green at this point. And granted, I have weeded out some of the worst players over time. So there definitely is some selection bias there. But it was the first time I really looked at it and said, wow, what's this sort of foreign green color I'm seeing all over here? And I do have one or two, a couple miners there that are up 50, 100%, that type of stuff. But I've got one or two that are up gargantuanly. And of course, that's why people used to miners used to be the crypto pre-crypto, right? Where the people would get hooked because you'd buy one stock that would go up 1,000 or 2,000%, right? And then you'd always be chasing to get that rush again. But that's starting to happen again here.
Yeah, absolutely. I mean, for people who are following this space, it's been tremendously exciting. But as you said, I mean, we paid our dues for years and years watching the value of the miners relative to gold just go lower and lower and lower. And every time it hit a new low, you thought, well, it can't possibly go any lower. And that it would take another stair step down. So I share your sort of bewilderment when I look at my portfolio and there's green on it. But it's a wonderful feeling. I just don't want to jinx myself by getting too excited because Lord knows the market gods will hurl their thunderbolts in my direction.
Yeah, well, and I think that's right. And as you said, gold's gone really far this year alone. I think it's gone from 2,000 to 3,400 or so since January of 2024. And of course, now we're seeing big gains in the other parts of the sector. So at some point, there's just got to be some sort of cooling off and pullback, just, sort of technically speaking. So yeah, don't want to take too many victory laps too soon. I will say though, I will admit to a little bit of envy for folks that got on the train, like 6 months ago or even now, where a lot of the risk of the nuclear winter that you and I had to soldier through has basically kind of been bled out, and it's now fun to be an investor in this space.
Exactly.
Yeah.
Well, timing is everything, I guess.
Timing is everything. And look, I'm going to ask you an unfair question here, which is coming from user TJ. I'm assuming he's asking here about the precious metals, but maybe this was a comment back to about bulletproof stocks. But let's make it about precious metals. How long can this go on? I think your answer is going to be, hey, look, as long as they continue to debase the currency's purchasing power. But I guess here, like, just pull back macro level. Like, Steph, if you said nobody cares right now, and that's the irony. Let's say people start caring. I'm not asking you for like a price target, but like, what do you think could continue to happen here to the price of gold and silver? Like, let's say, what's a price in 2 years' time if things continue going the way they're going that wouldn't shock you?
I mean, I wouldn't be shocked at all to see 5,000 or 6,000. But all of this comes down to whether and how soon and how materially the Fed decides to re-expand its balance sheet. And I think this was the interesting thing about the president's sort of tease last week, that he was, we came in one Wednesday morning to stories all over that he was going to fire Powell imminently. And the market tanked, 10-year yields went higher. The dollar obviously got clobbered. And I guess he got the information he wanted for the market and said, no, I have no thought whatsoever of firing Chair Powell, and everything reversed. So I think what we discovered is, and it's sort of confounding to me that the markets have rallied since, is that it almost doesn't matter. Here we are sitting waiting for the Fed to cut rates. But if the president goes ahead and does something that pulls forward rate cuts, the markets weren't greeting that with enthusiasm. So I think it really comes back to this question of what is the justification for cutting rates? And I obviously was highly skeptical about the justification for cutting rates last September. But, if you have the administration and the Atlanta Fed GDP, et cetera, forecasting solid growth, 2.5% type of growth, and employment, while slowing, hasn't fallen out of bed. We're not looking at 5% unemployment rate or anything close to that. So what is the urgency to cutting rates here? I don't see it. And I guess I worry that you're going to get into a scenario like September, where if the Fed does cut preemptive, what the markets perceive as preemptively, that the bond vigilantes will just add back every single basis point cut in the Fed funds rate to the long end of the yield curve, and we will have accomplished nothing. And so, to me, there's a very long-winded answer to your question.
That's all right.
All the fixation on the Fed cutting the Fed funds rate and when and how much, and whether it's Powell or the next Fed chairman, sort of misses the larger point, and that is that the Fed funds rate probably isn't the thing to be watching. What you want to watch is the balance sheet, and they've already tapered the taper, and I think it's just a matter of time before they cease any reduction in the balance sheet, and then pave the way for re-upping QE, which they'll probably call by some other name that's a little bit less obviously naked monetization, but
Right.
it'll be the same thing by another name. But so I guess my long-winded point is I'm not really as concerned about what the Fed does to the Fed funds rate. I think the case for gold rests entirely on the balance sheet. And my operating assumption, and the reason I'm bullish on gold, is that there is no alternative. This is the ultimate TINA. There is no alternative to Fed monetization of treasuries, given our current supply-demand dynamics. I mean, here we are. Think about this, Adam. We have this massive 37 trillion in debt and, 2 trillion plus annual deficits. And the best Congress can do is pass a $9 billion rescission package.
Right.
So, I mean, clearly we're never going to really seriously address the debt and deficit. And if we're not going to seriously address it, and at this point, honestly, I don't know, I think it's too late to do anything material. And I know that the president's objective is to get growth going enough that we can sort of try to grow our way out of it. But it'll take decades for that to happen. In the meantime, we have, because we financed all the debt at the front end of the yield curve, we have $7 trillion in debt that rolls over the next 12 months. And the foreign central banks are selling, so they're compounding that. You take that 7 trillion and you add 115 billion that they're selling, and then you add on top of that the amount that the Fed is selling. And clearly, something's got to give here. And I think what's going to give is the Fed's balance sheet.
Okay. Well, and I mean that right there. I think I heard you say, what's the short-term pressure to cut? And I think a short-term pressure to cut on the administration side is, hey, we want to get the short end down because we want to refinance this stuff on the short end going forward, right? And so we'll see if that happens. So it's funny in your answer there, Steph. It's like you were sitting in on the recording session that I had yesterday with Luke Groman and Darius Dale.
Okay.
So this is a nice commercial for that. So folks, that video is going to come out tomorrow, 11 a.m. Eastern, the normal time. They wanted to have a discussion basically about America's current fiscal situation and what the ultimate outcome is going to be. And they're very much in mental lockstep with you there, Steph. Okay. No huge surprise. I think that the one thing I'd underscore, and folks, you'll get all the details tomorrow, is it doesn't make them super bearish for asset prices. Now, they definitely think there can be corrections in there, and they think, yeah, stocks are overvalued, right now. But they think because they're going to try to grow their way out of it, it's not going to work. There's obviously going to be some, just hiccups that happen along the way that happen in economies in general. And the ultimate decision here is going to be the print button, as you believe it will be. And if you look at where all this is going and the fact that there's really just no way that we can cover our future debts, deficits, and unfunded entitlements with tax receipts going forward, even under the rosiest of scenarios, we're just going to have to get to this, inevitable printing, and then that is probably going to continue to support asset prices the way that it has. So don't expect stocks to, go to zero and stay there. Though there's going to be a lot more volatility in there, and they're saying you really got to be careful about this. But they are very concerned about even taking the AI threat out of the picture for a minute, just about the increased wealth concentration that trajectory has, right?
Yeah. Well, I mean, this is why I made the point at the top that you really need to look at the stock market performance relative to gold. You have to look at it in real terms, because I don't disagree with Luke and Darius at all that once the Fed decides to re-expand its balance sheet, it's going to be everything goes. The rising tide will lift all boats. My dear friend and client Dave Iben, who I know you've interviewed on your channel, reminds me all the time, no one lost money in the German stock market during the Weimar Republic because it kept pace. But what you're going to see is that relative to gold and precious metals that have maintained their store of value, what you're falling into if you are long equities is this inflation illusion of rising asset prices, when in fact, in real terms, you're going to be lucky to just stay even. But I think interestingly, maybe I'm being too cute, but I think that the risk to the stock market is the Fed funds cut. I mean, I think what's going to happen is the Fed is going to cut rates whenever it does and however much. And the markets will probably, having bought on the rumor, sell on the news. And maybe you see what I expect, and that is that if the long end comes down, it comes down ever so slightly, not in any material fashion. And in that moment, investors realize we're not going to get the relief that we've been betting on for 3 years now. We have doubled down and doubled down and doubled down on this bet that the Fed was going to cut rates, and rates would go right back to where they were, 5 years ago.
2019, yeah.
And so when that illusion is shattered, that is when, the stock market will probably have a pretty serious correction. And then the Fed will say, oh, crap, this isn't working. We're going to re-expand the balance sheet. And that will set the floor, and everything will take off together.
And that could very well happen where there's a new person at the Fed that is much more compliant with the president. And you can imagine the president will probably be saying at that time, throw the kitchen sink in there, buddy. Do whatever you got to do. Yeah.
I kind of like this idea that we might get into a thing where now Besant, I think, has persuaded Trump, and maybe that Wednesday market test persuaded Trump as well, that replacing Powell isn't really the way to go. But what he might do is name immediately his replacement, and then whoever that person is will start giving speeches all over the place on financial media, interviews, and whatever, about how much he's going to cut rates. So we'll have essentially a shadow Fed, and the markets will price in exactly the policy that this new person is articulating, and forget about Chair Powell. He will be a lame duck, and all the markets will be responding to is the policy dictate of the new chairman, even though he hasn't been installed yet.
He'll basically steal the bully pulpit from the Fed in advance, right? Because the Fed loves to jawbone. If they can move markets by talking, they'll do that all day long, right?
Absolutely. So all he has to do is name a replacement and get that person out there articulating what is the game plan, and the markets will immediately ignore Powell and start
listening to that person. That's really interesting. So, and I am going to get to more questions, folks. The problem here is Stephanie always just takes her answers in such interesting places. So, one of the questions that I've been asking recently is, I don't think Trump's going to replace Powell either, nor do I think he should. But let's assume for a second he did, right? Like truly replaced him, not your shadow Fed, but
Okay.
just Powell. I'm engineering a reason you're out, right? Were that to happen, why would anybody ever listen to the Fed again? Wouldn't you only just listen to the president because the president has demonstrated they can replace the Fed chair at will? And so the Fed chair's opinion doesn't matter, only the president's matter, right? I mean, that would be a really, to the extent you want to have a Fed that at least has the illusion of an independent entity, wouldn't that basically put a stake in it if Trump were to rip him out of there?
I mean, it's a good point. Yeah, I mean, I don't think the markets would greet him ripping him out of there. Well, we saw it on Wednesday with any enthusiasm for that reason. I mean, I think everyone agrees that they'd like to see an independent Fed. The problem is we also need an accountable Fed. And right now, independence has meant unaccountable. And I think that's a problem. And I don't know how we solve that problem while maintaining the independence. But that's really, I think, where the markets get a little nervous. And you're right, if suddenly we have a situation where it appears that the Fed is just an adjunct to the executive office,
right?
Then we got a problem.
Yeah.
Then it's like Turkey,
Then it's like what?
Turkey.
Oh yeah, like the Turkey the country. Erdogan.
Yes, sorry,
Yes.
not Thanksgiving turkey, Turkey the country. Sorry.
All right, so let's see. I'm going to grab a few more questions. I also have one more that you brought up that's related to our friend Peter Atwater. But here's a very tactical one. At what price point would you sell silver eagles and convert to gold? I'll give my quick answer, Steph, and then you can give yours. Where I don't necessarily have a price in mind. It's probably more gold-silver ratio. And for a good long while, the gold-silver ratio has been tilted in gold's favor. It is now finally starting to mean revert. And most mean reversions don't stop at the mean. They generally punch through. So I would wait for a clear sign that speculative fervor in silver is really taking off. And by that would be a gold-silver ratio below the mean, the historic mean. And the further it got away from that mean, I would say, okay, I'm probably going to start converting silver back into gold, but we're not there yet.
Yeah, I would 100% agree with that. I think you're absolutely right. I wouldn't be selling silver eagles anytime soon at all. They've got a lot of catch up to do.
Okay. Let me ask you this question. And people are laughing about your turkey comments there, Steph. So I asked this yesterday of Luke and Darius because they, as I mentioned, they are concerned that as wealth continues to concentrate into the hands of those that own it, we get increasingly, the distorted K-shaped economy becomes even more distorted, right?
Yeah, I saw your I post.
Okay, you did. All right, yeah. So, my kind of concern is that the K at this trajectory will eventually morph into an I-shaped economy, meaning a lowercase I, where you have all those with all the concentrated wealth at the top who are kind of in a protected, separate elite from everybody else, and everybody in the long, line below that dot is just increasingly getting left behind. And I know that sounds really demoralizing, but as long as this continues, I sadly don't see how that happens. How we avoid that. What are your thoughts?
Well, I mean, I think a lot of the policies that the administration has pursued have been geared to helping to address that problem. The whole business of reshoring production and creating a revitalized manufacturing sector here, and the no tax on tips. And a lot of this is really geared toward boosting blue collar jobs and trying to sort of narrow this yawning gap between the high end and the low end. But I think you're right. I mean, the thing that I worry about the most, since we're keep coming back to it, is the evisceration of inflation. And it's going to be invisible. It's not going to be like the Biden inflation where everyone saw it, in the grocery store. It's
Mm-hmm.
going to be silent but deadly via debased dollar purchasing power. And so the people at the top of the eye who have already a lot of wealth amassed might find that in real terms, they're flat or even lower, but it's not going to materially affect their lifestyles. Whereas the people on the lower end, it's really going to be a struggle in terms of amassing enough for retirement. I mean, how do you do that? That's going to be incredibly challenging. So that's what I worry about. But I do think the administration has tried to implement some policies to help boost Main Street. I mean, the ultimate way to fix that problem is to have a 2008 repeat. And what happens there is the high end net worth gets destroyed.
Right.
And so you can narrow the gap by the high end having their equity portfolios and their real estate portfolios, cut in half, um, which obviously doesn't really help anyone. It ends up hurting the low end as well because employment gets stocked, their
Right.
401ks get stocked. So it's bad for everyone, but it would, narrow that gap a little bit. But then, the response to that, of course, would be another massive bailout with more money printing that just we start the cycle all over
Well,
again.
exactly. That's why I'm so pessimistic about it. Is we to to break that cycle, we would need to let natural market forces have their way, and then
Right.
not step in to rescue. Right.
And no one has, there's no political will for that whatsoever. You're talking about like a Great Depression style scenario. So yeah, the only other alternative would be to revalue the currency, to have a hard money currency such that there are constraints to debasing the dollar and
Right.
printing money and bailing out people at nausea, which got us to this $37 trillion in debt in the first place.
Let me ask you just to totally prognosticate here for a second. Neither you nor I are spring chickens anymore, Steph, although you look much more like spring and I look like late fall.
Not at all. I probably look like a turkey. No chicken, just turkey.
What do you think? Are the odds above zero that at some point percent in our lifetime we might see a new monetary regime?
Absolutely. I mean, I think it will be far sooner than most people imagine. I mean, most people don't imagine we'll have a new monetary regime. But I think that we're at the point, and it's not just the US, and this is why. It's, Japan, the UK, Germany, all of the major industrial economies are in the same situation we are, with aging populations and completely untenable obligations to those aging populations, be it Social Security and welfare and all this stuff, that they've financed with loads of debt. So at some point, everybody's going to have to enlist the central bank balance sheet to absorb all, to print the money to pay for it. And I think there's a point at which you end up having to go back to a hard money alternative. And I do think it comes sooner than later, just because we're all at this kind of, look at Japan. It's sort of the perfect microcosm. We're all at this point where I think of, I'm old enough now for the original Star Trek, when Captain Kirk would keep saying, like, make me go faster or whatever. And he said, I can't give her any more, Captain. I mean, we're kind of at that point, right?
Yeah, I love that. Japan is Scotty down there in the warp room.
Exactly.
Yeah.
You can feel the Starship Enterprise shaking, as they try to keep pushing.
So I am looking for questions here, but we're spiraling in an interesting direction here, Steph. Is there a first mover advantage to the first major country that would do this monetary regime? I know it wouldn't be easy. I know there'd be a lot of costs to come with it that would be hard initially, and certainly all the politicians would have to live by the discipline of this new currency. But would the rest of the world, would capital from the rest of the world start flocking into that currency because it was a much more trustworthy currency than what was available previously?
One would think so. I mean, the Swiss franc for so many years was that currency. Yeah, I would think so. In terms of first mover advantage, though, I think at the end of the day, it's going to come down to who has the most gold relative to the amount of paper in circulation. And right now, the US likes to imagine that it has the largest gold reserve, but relative to the supply of dollars out there, it's piddling. But it's also not necessarily certain that the US has a bigger gold reserve than China, which
Right.
has been keeping its gold purchases sort of under the table and reporting with delay and massive understatement
Right. And they're
relative.
still buying a lot according to what they're reporting.
Right.
Right. Yeah. And
Right.
so if you figure there's a lot they're not telling us, yeah, exactly.
Yeah.
Yeah. Well, all right. So that will be super interesting.
Yeah.
By the way, we just got a very nice donation here by George. George, thank you very much. I didn't even realize you could do this, so thank you so much.
Yeah.
I will use that to treat Stephanie to a nice cocktail the next time
There
that we
you
are
go.
seeing each other, and we will toast you, George.
Great.
Okay, so this is a little orthogonal, but we did get a lot of questions about this on your X post there, Steph. So the U.S. is, the administration's desperate to refinance this debt, this Treasury debt that's coming up, right? The $9+ trillion, just in this year alone, right? $9 trillion, is that what it is? Steph?
To 7 trillion.
Sorry, 7 trillion. All right.
That's all right. I mean, it's
7, 9.
Pretty
we're
close.
at a couple
Exactly.
trillion, right? And it's hoping to do so. Well, anyways, it's desperate to get borrowing rates down to make that debt rollover more manageable. As you said, foreigners are cooling on buying the debt. At least foreign sovereign purchasers. And so we have all of a sudden this kind of just lightning pass through of the Genius Act, right? The Stablecoin Act. And
Yeah.
for a lot of people, sort of myself included, it was like, oh, okay. I mean, I kind of remember you being a little crypto friendly, on the campaign trail, but wow, this I guess was a big priority, right? And a lot of people are looking at that and saying, well, maybe the administration just wants a lot of new stable coins out there because to back them, they're going to have to buy U.S. Treasuries. So this
Right.
is just another incremental purchaser of Treasuries that'll, raise the Treasury price, lower the Treasury yield.
It's a massive money market fund, basically, that's going to sop up T-bill issuance. And in that regard, the desire to push this Genius Act really underscores the fact that we, again, are in this box. I mean, Scott Bessent on the campaign trail, or while he was, trying to get the job as Treasury Secretary, was out there deriding Janet Yellen for issuing all the debt at the front end of the yield curve, servicing our massive deficits with T-bills. And here he is, and he finds that's his only option now. He doesn't really have a choice, and that's why they urgently needed this stablecoin reserve so that they can create a source of ongoing demand for T-bills, and then they can continue to just finance at the front end. And they did that alongside this tweak, or their proposed tweak, to the supplemental leverage ratio for banks, which the idea there is to free up more capacity of the U.S. banks to buy treasuries, which I find kind of laughable because they're already sitting on almost $500 billion of unrealized losses on treasuries. So basically the government's now saying, hey, we're going to give you an opportunity to buy even more of this paper that you're losing money on. I mean, I don't know what the appetite for that is, to say nothing of the idea that thought the whole goal was to reprivatize the economy, and now you're encouraging the banks to lend to the government rather than the private sector. So that, these are all, when I look at it, seem like desperate measures being undertaken by people who are smart and understand the situation and are not inclined to take these steps but are being forced to do so because there are just no other options. And we're at the point where this is the only roadmap we can go down. So I view it again as a more, maybe I'm just looking for reinforcement of my conclusion, which is
Right.
that eventually they're going to have to re-expand the balance sheet. You're not going to drum up enough demand for treasuries from banks who are already losing money hand over fist on the ones they own, and from a stablecoin reserve, which I think the total market cap of stablecoins right now is, I could get this totally wrong, but I thought it was 200 or 300 billion. So even if that grows to $1 trillion tomorrow,
It's still a
against
small fraction of the
yeah,
7 trillion. Yeah.
really, I mean, it's something, but it's not enough.
Okay. So it does, it sounds like to you as well, sort of smack of financial engineering, right? Which is we're just trying to find ways, even if we have to steal from Peter to pay Paul, to get these treasuries sopped up here. And to your point, it's not that big anyways. And at some point, the math gap is so large, it's hard not to see eventually that the Fed is going to have to step in and solve it.
I can't resist mentioning this, but I talked to Art Laffer. I know you've talked to Art Laffer, but when I had the idea, I guess it's a year ago, last summer, that what they should do is make treasuries tax-free, and that way create domestic demand for treasuries to replace the exiting foreigners. I had a conversation, I talked to Art Laffer, I called him and I said, what do you think about this idea? And because he's, the biggest pro tax cut guy there is out there.
Right.
That's his whole, that's how he came to be the legend that he is. And his response was, well, I think it's a little gimmicky. And I haven't talked to him since, but I would argue like the measures that they're taking now are 5 times more gimmicky than making treasuries tax-free. I mean, that might actually create some real sustainable, durable demand, whereas the SLR and the stablecoin, maybe the stablecoin thing will grow into some enormous money market trove, basically. I'm not persuaded, but we'll see. But the SLR thing seems like really just pissing in the wind.
Yeah, and I'm actually surprised that Art would think that was gimmicky. One, because he just loves tax cuts. For
Exactly. I was surprised too.
But also treasuries.
And I took it a little personally. I'm like, gimmicky. I thought it was such a great idea.
Yeah, well, and also I know interest income. The interest that you get on your U.S. Treasuries are exempt at the state and local level. Right. So there already is some precedent there for this. I mean, I guess what you would do is you would do the math to say, okay, whatever we're losing in taxes on interest income or capital gains on these things, is that going to be more or less than the incremental purchasing of U.S. Treasuries? But I would imagine.
I did that math, and there's no comparison. I think the total capital gains receipts for all capital gains was like $200 billion a year. So the share of that's treasuries. I mean, even if you assume half of it, which is nothing close to that. So let's say it's 100 billion. Obviously, at 37 trillion, every 1 percentage point decline is $370 billion in interest savings.
Okay, yeah.
So there's no comparison. I mean, it's probably 5 times the benefit to the cost. That's not the issue. I guess it's maybe disenfranchising state and local governments who right now have the complete deductibility, tax-free status, and sort of maybe creating problems for state and local governments by providing competition for tax-free status with the federal government.
Right, okay.
But, I view the national security aspects of preserving our deficit financing as far more important than state and local government revenue situations. So
right. Well, and also too, I mean, we got to prepare ourselves for the part of the story where, for national security reasons or whatnot, Steph, they will say, look, everybody who's over 50 in their retirement account, especially with the high degree, the record high degree of exposure to stocks right now, there'll be some like Protect Grandma Act or something where it's going to be like, you really can't have over 50% of your portfolio in stocks after you're 50 years old, and those need to be invested in treasuries because that's
Safe,
good for
safe
you, right?
treasuries,
But
right?
it's also a huge new source of buying. Yeah, exactly.
Yeah.
Okay. Since we're talking here about bonds, there's a question here from this question, which says, what should a boomer do who's stuck in individual long-term treasuries? Do you expect a blip where long-term rates come down and we can sell them? Because I'm sure, this, like a lot of people who've been in the TLT trade, for the past couple of years, they have been stymied by rates remaining as stubbornly high as they've been, and are probably to a certain extent feeling trapped. So do you have any counsel here?
Well, for a long time, my real operating thesis, I'm sorry, I'm trying to think of a way to articulate this so that everyone can understand. I've been a devout worshiper at the altar of reflexivity, and that is this idea that interest rates or anything will rise to the point that it sows the seeds of its own decline. It's especially true with currencies and interest rates. George Soros happened to be one of the uh, first people to kind of pursue this notion. And my feeling, talking in the context of these Fed rate cuts not really having efficacy as the long end refuses to come down, is that that will happen to a point that it creates a correction either in the stock market or a recession in the economy or both, at which point you'll probably get that reflexive decline in the long end. However, the caveat would be that I expect that decline to be far less dramatic and to last for a far shorter period of time, because it will only take the average investor about 37 seconds to figure out that an economic downturn is going to lead to larger deficits, which is going to continue to put upward pressure on the long end of the yield curve. So if you blink, you might miss the rally. I think there will be one. I don't think it'll be super dramatic, but I'm sure you will at some point get an opportunity to sell. Probably not at the kind of levels you would like to, but that's my 2 cents on it for whatever that's worth.
Okay.
Probably ain't much.
I'm going to ask you to put your guessing hat on again too here, Steph. Short of another like GFC style seizure in the financial markets, do you see us returning to a ZERP world or 1% interest rates, or are we, in a secularly higher regime now?
I mean, the question is, how far do they push the Fed funds rate to no effect before they give up and just start enlisting the balance sheet? Um, and I obviously don't have an answer to that question, but I wouldn't expect to go back to ZERP. But I wouldn't rule it out. I just don't think it will end up, when you're talking about ZERP in terms of the front end of the yield curve, I don't know that they would ever take Fed funds rate negative. But I do think that they will expand the balance sheet and buy enough long dated treasuries to eventually get those yields
Start
down
bringing that down. Yeah.
pretty, yeah. However, again, you've got to put that in the context of the silent dollar debasement that will entail. So while you might think, well, that's going to be my opportunity to buy treasuries, well, in real terms, you're going to be completely wiped out. So not sure that I would be a huge fan of that trade.
Okay, yeah. And on that topic, the folks I know who are much better informed on this topic than me, like Tom Honig, the former
Yes. Kansas
former
City.
FOMC member, and Kansas City Fed head. If I remember those discussions correctly, he was saying they were really kind of getting a lot of blowback on QE by the end of it, and a real realization that it did result in a lot of wealth inequality that is very damaging to the social fabric of the country. And so it's a tool. They're not saying it's a tool that's never going to be taken out again, and I think you probably feel confident it will be at some point, but it's a tool that's going to be taken out with some hesitancy.
Mm-hmm.
And yeah, and there's lots of reasons right now to expect that the market naturally isn't going to bring rates down as low as where we saw them, and it's going to be harder for the central banks to get rates as low as they were before. So there's some people that are sitting on these bonds thinking, okay, we're going back to zero, right?
Mm-hmm.
And I just think the probability of that happening, at least on any timeline that is attractive as an investor, is a low enough probability that I would say, unless you're doing that as a hedge,
Yeah.
good luck with that one.
Yeah, I would agree with that. Absolutely.
Okay. All right. Well, look, folks, we are a few minutes away from the hour here. If you've got any more questions for Steph, feel free to ask him here.
I love this. Here's Tom Fredrickson. If you can't hold it, you don't own it.
Own it. Yeah. Well, somebody was asking why. So I'll ask you this question. Why buy the real stuff if you can just buy GLD? And I think to a certain extent that answers it somewhat.
Yeah, absolutely. And also, I wouldn't own GLD. I would own FIZZ for that reason. FIZZ, if people are unfamiliar, is Sprott's gold trust, and it's
Right.
redeemable in physical bullion, and they audit all the time. So and you have allocated bars. So it's very different from GLD, which doesn't give you that option.
Right. And GLD, it's funny. I don't know if this was the case at one point in time, but there certainly were gold ETFs out there, whether GLD was one of them or not, that wasn't backed with ounces and basically owned gold futures. Right.
Mm-hmm.
And the concern about that is hey, if there's ever a real like scramble for the physical metal, you may be worth holding, a paper contract there that has big counterparty risk, right? That even though it says you now, at the end of this contract, that gold's yours. If they don't deliver it to you, it doesn't matter, right?
Right.
Now, I did go back and check GLD on this, and it sounds like they actually own the real ounces, but they don't have what you're talking about, Steph, which is the potential for convertibility. And I know there's some other funds out there like VanEck Ounz, OUNZ, where again, you can, I think on demand practically say, hey, you know what, convert this to the ounces, ship me the ounces. Now I'll tell you, that's not the most affordable way to get your ounces of gold.
Right.
If what you want to do is hold physical ounces at the end of the day, much more
the best way to do it is Costco.
Yeah, I mean it's crazy. But Costco is becoming one of the best places to buy your precious metals, and of course,
if you can get it, they can't keep it in stock, so that's the problem. But
yeah, but I guess on this topic, I do just want to make one comment, and then Steph, you can add to it any way you like, which is, well, first off, folks, if you haven't read it yet, I've got the free guide that I put together in response to all these gold-related questions and how to buy it and own it and store it. It's at thoughtfulmoney.com/gold. And it just walks you through all the different ways in which you can hold or own precious metals and sort of the pros and cons of each, like when it makes sense, when it doesn't make sense, and also gets into mining stocks and the paper assets that you can own on top of that. And in general, sort of what I counsel people is you want your sort of Armageddon currency crisis, physical stash that is somewhere where you can get your hands on it very quickly. Right, that's the stuff that you hold and you own. Right, now you don't want to have too much because then it becomes a loss risk or a theft risk. Right, so you don't necessarily want to hold all of the gold that you own in your closet or wherever it is that you're storing it. Right, so at some point you say, you know what, I still want to own more physical, but I want to have it in some place that's more securely stored than wherever whatever hidey hole I have it in, right near me. And for some people, that might be a bank safety deposit box. And I know that there are some people that don't think that's a good option. It might be with a private vaulting facility, and there are plenty out there. And if you want to talk about this in more depth, Andy Sheckman, who comes on this program every couple of weeks, he offers great services there. And you can just email him at info@milesfranklin.com, and he can walk through all the options that are there. So for more physical stuff, you hold as much as you feel comfortable that you can sleep with at night near you. Then you put the rest in some more secure location like that. And then the question becomes, Steph, if you're still excited about gold and you think it's got price appreciation ahead of it, what do you do next? And that is where the paper gold assets come into play.
Yeah.
If it's exposure to gold that you're not going to call back to yourself at some point, but you want to have basically the most liquid and price efficient way to get exposure to the price of gold, that's where then the paper gold asset comes in, right? So the way I sort of look at it is there's this, it's funny to call it a stack because that's what people call their stashes of physical, but it's this stack of options that as you have more capital, you start moving up that stack, right? The stuff that you hold, the stuff that's stored in your name securely, that's physical. Then you can start the paper ETFs. Then you can start getting into the mining stocks, and you'll want to start with the majors because they're the safer ones. Then you go to the juniors, right? So there's this stack you go up depending upon where you are in your physical metal journey. So anyways, that was a lot, but I'm curious if you have anything to add to improve that.
No, that's what I was going to say, is that as you're doing, moving from the physical into the paper, that the miners obviously would be a step. The other one, at the risk of being viewed as promoting Sprott, but I happen to have a big position in the FIZZ, obviously. Cy Jacobs, who I don't know if you've ever interviewed on your channel.
I haven't.
His way to get exposure to the precious metal space has been to go long Sprott. So you can't, there are other things you can buy. I don't know if Van Eck is publicly traded, but you can find these sort of non-mining companies that have these paper gold vehicles and invest in them as a proxy for
That's
gold.
interesting.
And the thing with Sprott is they also do, platinum and silver, and they have a variety of funds that deal with the precious metals. So it's a good way to get exposure to all of them in one place. But again, you have idiosyncratic risk. Who knows what happens to Sprott? Whenever you put your money in one basket, you're exposed to whatever
the business risk of that entity.
Risk. So I'm not necessarily advocating it. I'm just saying that's an idea.
It's an interesting idea.
It is.
And I guess I would say that's really to get exposure to hard assets, right? Because Sprott has other funds that it runs that are in uranium and other things like that,
Correct.
right?
Yeah. And uranium is another big one. So, but
anyway. Well, I'm wrapping up here. Do you have any thoughts on that in general? Is that a market you follow?
Just the idea that we're going to start to, expand nuclear in general, and that's the bull case for uranium. I mean, we have sort of an everything is on the table approach to energy policy here in the United States. So I think that's very bullish for nuclear as well, or nuclear, as W would have called it.
Yeah, nuclear. I've had some deeper talks with energy folks here on the promise of nuclear, so I won't get into it deeply here. I'll just say that I've got a couple of nuclear securities and that are in that account that are surprisingly green now, which is nice. I mentioned one on this program like 6 months ago when it first caught my eye, and that's Oklo, OKLO, and it's the nuclear venture that Sam Altman from OpenAI has been investing in, and because he knows we need to really dramatically upgrade America's electricity production to feed AI in the future. And that thing has gone bananas, right? And is it in a speculative bubble at this point in time? I don't know. It's going to be years and years before Oklo has $1 of revenue. So, it is, I guess, very speculative from that in general. But even like I've got a couple of ETFs that just track the price of uranium, and those have done quite well.
Mm-hmm. Yeah, no, it's another very interesting area. And as you said, I mean, this whole AI thing, that's what's really interesting to me. I am terrified by AI itself a little bit, given my technophobia. That's a fairly scary thing. But the energy consumption aspect of it is something that I don't know is getting enough attention, especially when you think about it on top of the energy consumption of the crypto mining, Bitcoin mining and all of that, which also consumes a massive amount of energy. So we've got all these great new revolutionary technologies, but at the end of the day, it all comes back to the basic resources upon which all of these things depend. And those basic resources are so grossly underpriced relative to paper assets. I mean, if you just look at the stock market relative to the CRB index, for example, you know, a broad commodity index, it's like that miners chart used to be relative to gold. I mean, it just it's so low and it's hitting, you know, multi-decade
Right.
lows. And so this is something that, you know, people like me have been real advocates of, this idea that we're undertaking a secular shift away from paper assets to hard
And to hard
assets.
assets. Yeah.
And right now, like between AI and crypto, well, I mean, crypto is not considered a paper asset, but AI and these Nvidia stocks and all of this going bananas without a like enthusiasm for the energy producers
Sector.
that
Yeah.
will be required to support it.
Yeah, yeah, and I think that's the optimism in this story. You know, it's easy to kind of get wrapped up in a lot of the concerns that you know we field every day, Steph. But like from an individual standpoint, you can position yourself in front of that wave. And again, that was the key theme of Rick Rule's symposium in Florida that I was at.
Sure.
You know, no big surprise, but you know, Rick's been in this business for a long time. He's seen a lot of business cycles. He's definitely very optimistic about where we are in this current cycle, meaning there's a lot of boom years ahead of us in the natural resources space from his perspective. And Steph, that's actually what's interesting about that is both the opportunity that you're talking about, but also the fact that we have underinvested in capex in a lot of these industries. So Rick's like, even if demand doesn't grow by 1% from here, we're still going to enter shortages in a lot of these key materials because of sins of the past, of investments that we didn't make. Now you put the opportunity and a future demand on top of that, it really becomes really interesting. So for those that are awake and aware and educating themselves and getting exposure into this space, you've got a lot of, you know, real potential ahead of you. And so that's the agency we have on our side. And then, you know, again, America's got a lot of problems. But to your point, Steph, so does the rest of the world. And a lot of them, on a relative basis, have way worse problems than we. I wouldn't want to be Japan right now, to your point.
Right.
And when you think about it as a natural resources game, we are super blessed here in the US, right? And there's a ton of natural resources that we have not tapped. And you might think that's for good reasons, you might think it's for bad reasons, but as Doomberg likes to say, it's a lot easier to change a political constraint than a geological one.
Yes.
Hey, if you don't have any oil, you know, deposits in your country, you're not going to get any oil. But if you have oil deposits that you're not tapping because of reason X, Y, or Z, well, you can change that reason and get to that oil if you want, right?
Yep.
And you know, I think of things like with China right now, one of the things they have us over a barrel on is rare earths. It's not that we don't have rare earth metals, we do. We just haven't been mining them as much, and we've been relying on China for all the refining, and that's really where they've gotten ahead of us. Now, can we learn how to do that? Absolutely. Will it take us a couple years? Yes. Can you bet we're absolutely pedal to the metal trying to develop that capability internally? Yes, we are. And so we have the ability here in the US to really be a natural resources powerhouse. And then, of course, you look at our friends to the north and south, right? I mean, despite some of the ruffled feathers our president has made in Canada and Mexico of late, we're all still great friends. In Greenland, exactly, yeah. But it's a great point. I mean, Greenland is totally untapped, basically, from a natural resource system. We have so much more natural resources per capita in our hemisphere than the rest of the world, and we have more or less friendly relations with all these people. There's no reason why we can't be doing trade together even more tightly. You know, Trump may build the Golden Dome and say, hey, anybody that wants to, you know, play on Team America in the Western Hemisphere, you're going to get covered by this too. There's just all sorts of benefits there where we could really use our natural resources per capita advantage to dramatically increase the relative prosperity of the West versus the other parts of the world. So again, that's just, look, it's not all negative, it's not all doom and gloom. We just need to seize this opportunity intelligently and figure out how to shock absorb the sins of the past that we're just going to have to pay no matter what happens.
Yeah, absolutely. And I think from an investment standpoint, this is an area where there's so much opportunity. And so wringing the next 10% out of NVIDIA, and I don't mean to just single that out all the time, but you know, these Mag 7 companies that have run so far so fast is far less compelling to me than buying these super cheap resource producing companies because that, you know, as we've been saying, is going to be a long-term play that should reap tremendous rewards over the next, several decades.
Yeah, and benefit from some of these trends that scare us, right? Like
Yeah.
the devaluation of the dollar, or even the dollar continuing to weaken versus other currencies or stuff like that.
Yep.
Those are all tailwinds to that. So
Yep.
it's nice to turn some of our concerns into investing tailwinds. All right, Steph. So as we wrap up here, lots of great feedback here on you, Steph. I hope you see it as it goes on here.
Well, other
I
than my
don't know.
microphone, I've got to figure this out next time. So, because
Yeah, well,
I
you and
hate
I.
the sound of my voice, but hearing it twice is just like nails on the chalkboard.
All right. Well, you and I will work on that off camera, but
Uh,
we'll make sure we fix that before next time. I promise too, I won't make you wear Vulcan ears like some people were saying. When you made your Star Trek reference, people were
Oh,
like,
yeah.
"Oh,
Oh,
we've got
my
to put some
God.
Vulcan ears on
My
Steph."
ears are big enough that they probably are Vulcan ears.
No, not at
Anyway.
all. All right. So last question for you, or last main question for you, which is there anything burning brightly on your radar or that you're noodling on right now that I haven't been thoughtful enough to ask you?
No, I mean, you're always so thoughtful, and you asked me a lot of really good questions. I mean, the one thing that was sort of in my mind was this idea that the president will appoint, announce his Fed person, and they'll
Yep.
articulate the strategy, and that'll be, the new policy directive, and Powell will be a lame duck. That was pretty much it, which isn't profoundly insightful by any stretch of the imagination.
I actually think
Um,
it's a really important idea. No, I think that's a really important idea.
Yeah. So we'll see. I mean, he's been quiet on the Fed for at least 24 hours. So we'll see.
Yeah. Actually, let me just ask you this real quick because it's been sort of breaking news. So we just announced a deal with
With Japan.
Japan,
Yeah.
and we struck one recently with Indonesia and then the Philippines. It's funny. I remember when the Indonesia deal came out, people really wrote it off, but I'm like, it is like the fourth most populous nation in the world, and they just opened it up to like our agricultural products for the first time. I'm sure those hundreds of millions of people would love to have a little bit of more beef in their diet, right? So, anyways, but no argument. Japan is a much bigger deal than Indonesia or Philippines. Do you have an opinion on the trajectory of these trade deals and the whole tariff thing at this point in time? Is it becoming any clearer for you what we should expect from this, or still is there too much dust in the air?
Well, it does seem like 15% is kind of going to be the number, somewhere 10 to 15% country dependent. But I think what's interesting and doesn't get contemplated in this discussion of tariffs is the fact mentioned at the top that the dollar is down 10% year to date. So do we even need the tariffs? We've already increased the cost. They've
Right.
effectively had a 10% tariff placed on their goods by the dollar decline. So now their effective tariff rate is 25% so far. We'll see what the dollar does from here. But so that's something to keep in mind as relates to these trade deal negotiations, is that it's sort of the open secret that the administration has been very much in favor of a weaker dollar, as a mechanism to rebalance trade. But that again brings me back to this riddle of how are we going to finance our deficits if we're basically going to be sending fewer dollars to the rest of the world for their goods that they quote unquote need to recycle into our treasuries. So
Right.
it just, the trade thing, I understand the objective of reshoring production, especially as relates to important national security type of products and services. But it does not come without material consequences for the financing of our deficits, and just kind of, again, makes me more convinced that it's a matter of time before the Fed has to step in and take the reins.
All right. And I like the consistency of your
I'm
logic.
I'm a broken record. That's a euphemism for that.
No,
But
no, no, no. It just shows that the logic holds, where much of what goes on ties back to the key themes that you're always warning us about. All right, folks. Well, look. Please do me a favor and mention there in the live chat if you're watching this live, or the comments if you're watching the replay. Just let us know how you're enjoying these bi-weekly sessions with Steph. I'm presuming from the feedback I generally see, you continue to love having Steph on the program as much as I do. But we always love to listen to you. But obviously, we want Steph to continue to come back and do this. So if you indeed want her to keep coming, please let her know. And all right, you're already getting lots of great things here, Steph. So it's what I was hoping and what I expected. But it's always good to just take the audience's temperature from time to time. So now, Steph, you do us the great honor of coming on here every other week. But if folks want more Pomboy in between your appearances here, please remind them where they can go.
Okay, well, at Pomboy on Twitter, although I've been on a Twitter dry spell for quite a while here. Macromavens.com, probably the best place, and you can read some sample reports and learn how to subscribe. And I do this product monthly, and then you have access to podcasts, etc. So you can find out about that there.
All right, and Steph, hopefully you'll see I'm putting the URL up on the screen here for folks to go. And folks, please, again, if you want us to continue doing this bi-weekly, please help us know you want us to do that by hitting that like button before you go. And just a reminder too, click on that subscribe button. I've been saying in this month here of July to really try to encourage all of you who are watching who haven't subscribed yet to please do so. Only takes you a second. Reason why I'd love for you to do so is one, you'll get a benefit out of it. You'll get alerted every time we do a new video in the future, so that way you're not missing great content. But it really helps this channel because the more people who watch who are subscribed, the more love the algorithms give this channel and shares these videos with other like-minded investors like you. So it helps our mission out there in the world. I'd also love for you to do it too, because I'm trying to hit 150,000 subscribers on this channel by month end, which is coming up pretty fast now. And that's my birthday, and I would love to be able to celebrate a big milestone like that on my birthday.
Oh my gosh.
I know.
Happy early birthday.
Thank you. I talked about not being a spring chicken anymore. It's definitely not. And just as a quick reminder to folks too, if you would like to get some help in managing your portfolio through the twists and turns that Steph and I have talked about may potentially lie ahead here, as usual, highly recommend that if you don't already have a good professional financial advisor advising you, consider scheduling a free consultation with one of the ones that Thoughtful Money endorses. These are the firms you see with me on this channel week in and week out. To do that, to request one of those free consultations, just fill out the short form there at thoughtfulmoney.com. You see the URL on the screen. And as a reminder, these are totally free. There's no commitments to work with this firm. It's just a free service they offer to be as helpful as possible to as many people as possible. All right, Steph, the time just goes so fast when I talk with you. It's always such a joy. It is definitely the highlight of my every other week. I interview that guy Lance Roberts every week, and my God, that's just like pulling teeth. But with you, it is just a pure joy.
Well, I'm reading through some of the comments, and they want more dog. And they missed it because she was just slightly out of the camera, rolling all over the carpet and making a ton of noise. So I'm glad no one heard that.
Yeah, she was under your coffee table there for a little bit, but it looks like she moved.
Oh, did you see it? Okay, I thought she was out. Now she's snoring away on her bed. So she's here. She's ever present. But next time I'll make sure she's more prominently featured, so you have some distraction from this.
All right, I'll try to send you a bag of dog treats that maybe you can feed her one or two during next week's session.
She's got plenty of dog treats, I promise. She's getting fat and happy. Anyway, great seeing you again, Adam. Looking forward to regrouping in a couple of weeks and comparing the latest emanations from the White House.
All right. Yeah, I think the one guarantee is there's going to be a lot of twists and turns that we can't even imagine right now between now and then. But anyway, Steph,
I love it. I love it.
Well, it keeps things interesting, which is fun. All right. Well, look, Steph, great as always. Look forward to seeing you in 2 weeks, and everybody else. Thanks so much for watching.